They're not as obvious as they were because we had a foreign exchange play throughout 2016 where the pound fell against the dollar by about 18% and 12% against the euro. That's ironed itself out by the pound becoming stronger in the last 6 months, and we are also very, very concerned about the possibility of companies not delivering the level of profitability that we thought we might. But anyway, we pick out of the sack Prudential. Barry Corns, our analyst, is very keen on this because it's doing extremely well in the United States now again, and also is measuring up well against AIA in Asia, and also some of the pension schemes that are on offer in this country, we think make it an extremely attractive prospect. Apart from that, I think you can look at the banks, because if we are going to get some level of interest rate increase, and also the fact that we are going to see more international business become more fragmented, which could focus a little bit more on the domestic banks, perhaps it might be possible to look at Royal Bank of Scotland ahead of the possibility of a sale of about £3 billion worth of assets in 2019. And the other one I think we'd have to focus on is probably AstraZeneca, because healthcare is becoming extremely important and there's an awful lot of money being invested in the development of it. Well, they vary enormously. I'd also like to talk negatively about one or two of them as well, but in the technology stocks, I think probably Loop, which is a company that Panmure Gordon brought to the market. Peter McNally, our analyst, is very keen on this going forward. For the pharmaceuticals, Farron Pharmaceuticals, Dr. Julie Simmons has recommended as something that she would very much like to look forward to. And we've got Speedy Hire, which is a company that's done extremely well in 2017, and we are hopeful that despite issues, as I say, as regards valuations in terms of being able to deliver profitability, we're extremely keen on as well. Apart from that, on a negative side of things, one of the areas that I think, because margins are so thin, we've got a slightly negative approach, which of course Mark Irvine Fortescue thinks about TUI travel. And the same in the defence sector, where Sanjay Jar, our analyst there, feels that Meggitt is perhaps not quite what it should be. But on the whole, this will be 2018 a time for stock picking. And there are a lot of other good companies out there. I'd like to recommend Hilton Foods, which is again a company that our retail analyst, Mark Fortescue Irvin also recommends. Definitely, because we've seen, particularly in North America, some very, very frothy valuations. The P ratio in the Dow is somewhere around 24%, 18% in the S&P 500, and something like 26% the Nasdaq. They're all very frothy in Hong Kong, 31%. Valuations are going to be the real problem here, and we wouldn't be at all surprised to see some kind of a correction, because we don't think the level of profitability that we've seen and growth that we've seen from companies can be sustained at these levels. So if there were a correction of 5 to 10% amongst the main indices, wouldn't remotely surprise us. In the case of the FTSE, we think that's a stock picker because it's going to be geared entirely to the value of the pound, and we think the real value will be selecting really positive companies out of the 250, where the growth will come, if it's going to come at all, in the United Kingdom. Where will it end in 2018? My guess is that it will end. It's above 7,000 at the moment, and we think it probably could be down as low as 6,800. I think Loop. I'm very keen on technology stocks, particularly those that offer something that other people don't have. And this is a company, that we're really interested in, and I think will do extremely well.